How to determine your risk-reward ratio. A trading risk-reward ratio, often abbreviated as R, or R to R, is a fundamental principle in trading that assesses the potential profit relative to the potential loss of a trade. It quantifies the amount of risk undertaken in comparison to the potential reward sought. In essence, it serves as a risk management tool, helping traders make informed decisions by weighing the potential gains against the potential losses before entering a trade. Understanding the risk-reward ratio is paramount for traders as it provides a framework for evaluating the viability of a trade. By assessing the potential reward relative to the risk involved, traders can make more calculated decisions, thereby improving their overall profitability and risk management. While a higher risk-reward ratio may offer the potential for larger profits, it also entails greater risk. Traders should strike a balance between risk and reward based on their individual goals and risk tolerance. The risk-reward ratio comprises two primary components: risk and reward. Risk refers to the amount of capital that a trader is willing to lose on a particular trade, while reward denotes the potential profit that the trader aims to achieve. The ratio is calculated by dividing the potential reward by the potential risk. Just a quick note to please hit the like button and subscribe to the channel for more content like this. You can visit us on the web at www.investmenttees.com and use code BLOG to receive 25% on your next purchase. Also, do follow us at Investment Tees on all social media platforms. Determining an optimal risk-reward ratio depends on various factors, including the trader's risk tolerance, trading strategy, market conditions, and individual preferences. While there is no one-size-fits-all ratio, experienced traders often aim for a favorable risk-reward ratio that maximizes potential profits while minimizing potential losses. The ideal risk-reward ratio for day trading varies depending on the trader's strategy and preferences. Some traders may opt for a 1-to-1 ratio, aiming to achieve equal potential gains and losses on each trade, while others may prefer a higher ratio to pursue larger profits. To calculate the risk-reward ratio of a trade, divide the potential reward, target profit, by the potential risk, stop loss. For example, if the potential reward is $200 and the potential risk is $100, the risk-reward ratio would be 2-to-1. A risk-reward ratio cannot be negative. It is always expressed as a positive value, indicating the potential reward relative to the risk. Risk-reward ratios can vary between different asset classes due to differences in volatility, liquidity, and other market characteristics. It is essential for traders to adapt their risk-reward ratios accordingly based on the specificities of each asset class. Several factors influence the selection of an appropriate risk-reward ratio, such as risk tolerance. Risk tolerance varies among traders and is influenced by factors such as financial situation, experience, and psychological makeup. Traders with a higher risk tolerance may opt for a more aggressive risk-reward ratio, aiming for larger potential profits despite the increased risk, while those with a lower risk tolerance may prefer a more conservative approach. Market conditions. Market conditions play a significant role in determining the optimal risk-reward ratio. In volatile markets, traders may adjust their risk-reward ratios to account for increased price fluctuations and heightened uncertainty. Conversely, in stable markets, traders may adopt a more conservative approach to mitigate potential risks. Trading strategy. Different trading strategies may require varying risk-reward ratios. For instance, day traders employing short-term strategies may opt for smaller risk-reward ratios to capitalize on quick price movements, while swing traders employing longer-term strategies may prefer larger risk-reward ratios to capture larger price swings. Position sizing. Position sizing, or the determination of the amount of capital allocated to each trade, also influences the choice of risk-reward ratio. Traders may adjust their risk-reward ratios based on their position sizes to maintain consistent risk management across their trading portfolio. Psychological factors. Psychological factors, such as fear, greed, and emotional biases, can impact a trader's decision-making process and, consequently, their choice of risk-reward ratio. It is essential for traders to remain disciplined and objective, adhering to their predetermined risk management rules regardless of emotional impulses. Determining a suitable risk-reward ratio requires careful consideration of the aforementioned factors, coupled with thorough analysis and experimentation. Here are some steps to help you determine an optimal level. Assess your risk tolerance. Begin by evaluating your risk tolerance and financial goals. Consider how much capital you are willing to risk on each trade and how much potential profit you aim to achieve. Traders should reassess their risk-reward ratios periodically, especially when market conditions change or when they experience significant shifts in their trading performance. Regular evaluation ensures that the chosen ratios remain aligned with the trader's objectives and market dynamics. Backtesting and analysis. Conduct thorough backtesting and analysis of your trading strategy to assess its historical performance under various risk-reward ratios. Identify patterns and trends to help you gauge the effectiveness of different ratios. Experimentation. Experiment with different risk-reward ratios in a simulated or demo trading environment to observe their impact on your overall trading performance. Adjust the ratios based on your findings and refine your approach accordingly. Continuous monitoring and adaptation. Continuously monitor your trading results and adapt your risk-reward ratios as needed based on changing market conditions, evolving strategies, and lessons learned from experience. Ultimately, finding the right risk-reward ratio for you involves a balance between potential profitability and risk management. It's essential to consider your own risk tolerance, trading strategy, and market conditions when determining what constitutes a good level for you. Additionally, backtesting and analyzing your past trades can help you identify what risk-reward ratio works best for your trading style. Conclusion. Understanding the trading risk-reward ratio is essential for any trader aiming to navigate the financial markets successfully. By evaluating the potential risks and rewards of each trade and determining an optimal risk-reward ratio tailored to individual preferences and strategies, traders can enhance their profitability and risk management capabilities. Remember, finding the right balance between risk and reward is key to long-term trading success. Continuously assess and refine your risk-reward ratios based on evolving market conditions and lessons learned from experience. Thank you for watching.